This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Henry Yoshida, an experienced angel investor. Henry, thank you for joining us.
Thanks, Hall. Great to be here.
Can you tell us a little bit how you got to be an angel investor? Everybody has a unique path. What was yours?
Yeah, so for the most part, I was kind of going down the corporate employee path for a very long time. I'd always been entrepreneurial, even in the jobs that I'd had within the corporate world. Started my own companies in 2010 and 14. One was consulting, the other was technology. Both got exited. And then after the technology one, I actually just made a very proactive decision to take a percentage of the money that I'd made from that exit and decided that I was going to use some of it to become an angel investor. So partly, I didn't go into angel investing thinking that I'd make a fortune off of it. I think that part of it for me was that I felt like I didn't get a chance to learn everything that I wanted to learn on the entrepreneur side of a venture angel investor-backed technology company. And angel investing to me was actually another way to continue my learning, partly by way of the other angels in the deal and partly by way of being able to sort of vicariously live through the investments themselves and watch them grow.
And so what do you look for? What kind of deals do you do? And what do you look for in those deals to pursue?
Yeah. So, for me, at first, I started like anyone else. I made my first angel investment back in 2013, and I didn't even know where to start. So like most, I sought out a couple of networks. I joined a couple of professional angel investor network groups. And, what I determined was that rather than trying to focus on one particular industry, it actually made more sense to try to focus on a particular stage. And I think if you're an angel investor, it just made the absolute most sense to go in as early as possible at the lowest valuation possible. And then hopefully, guide a company and get them in a position where they grow and they start getting the wind behind their sails in the form of institutional investors. But that's the way that I felt that you could get the most value long run out of your angel investments.
So how far along do they have to be before you would engage with them? I know you want to go as early as possible, but is two guys with an idea in the game for you, or do you have to see a prototype or some revenue?
So when I say early, I do literally mean early. So in some cases, it was just an idea. They might have had a prototype, but in a lot of cases, I guess I would say that the companies that about half of the angel investments I've done out of 15 deals were actually 1/3 to 1/2 were actually pre-revenue, but they had a product. So they had a prototype, but they hadn't been making money off of that product. I think maybe only one was pre-revenue and pre-product, and it was just based on an idea. And I think it was less on the idea itself than on the track record and previous execution capabilities of the founding team than it was an idea.
So you're looking for either product validation or market validation, but it sounds like you don't always get both. And how do you decide which of those deals do you pursue? Because there's quite a few in that category around here.
Yeah, I don't know that I consider myself the person that becomes the first check-in and then tries to evangelize the deal to get other angels to follow. I think that most of my deals did come by way of some sort of vetting process through a professional angel investor network group. So one I'm involved in locally here in Austin, another one that has a more national presence. And I think the way that I make the decision is that it's a little bit of group thing. So if it's not just me and it's a couple of other people that might say that, hey, look, this product itself has a reason to exist. Now, whether that's been validated or not is probably something that hasn't quite happened yet. But if I'm not the only person in the room among people more experienced than myself that think that, then probably makes sense for us, especially if we can collectively come together, which is another thing. So you collectively put some checks together to formulate a seed round, then odds are better that the company will be able to buy some time to get that validation fit attached to the product. So not just me, maybe a group.
So when an entrepreneur is pitching you, what are you listening for that says, I'm interested in that deal, I want to go for it? And what are you listening for that says, no, I'm out of this deal? What are the goes and the no-goes that you're listening for in these pitches?
So it's a great question, Hall. I think maybe in the earlier days, I probably tried to be the person sitting in the audience and thinking to myself that, wow, do I have that problem personally, or do I know someone that has that problem personally? But then I realized that I'm probably not the person that's exposed to all the problems of the world that might have valuable or future valuable solutions to it. So I think that now I've trained myself a little bit better to think and sort of understand if the entrepreneur is talking and proving to me that they've deeply thought about the problem. So it's easy to sort of state that there's one particular problem that might be an annoyance at worst and truly a problem that needs to be solved at best. But, as you're listening to an entrepreneur, take yourself out of it from that personal perspective and then really start to evaluate the entrepreneur's critical thinking and maybe thinking about multi-dimensions and just getting convinced that they've thought through the problem from multiple angles. I think that's probably the thing that I key on the most.
And what's a key term that completely takes you out of the deal? What do you listen for that says, I'm not doing that deal or doing that deal again? I've done that before and it doesn't work.
Maybe the key term for me is just someone who is not really committed to the game. So I don't like the folks that continue to sort of moonlight. I like the ones that are sort of diving headfirst into a particular venture. I also want to see that at this point, you're going on very little product validation and likely almost no market validation. So another key skill that you want to go back and you want to hear from, but if the entrepreneur can't solve this problem, then you'd likely be out too, is do they have the ability to recruit a capable team around them and essentially get them around one common goal? And are they able to recruit that team without having to pay, let's say, some exorbitantly high salaries? But, people making sacrifices based on the stage of the company. I want to see that. And if they tell me that they got this great person who came from this great big corporation and really worked in this space, but they had to pay the person $200,000 and they're only working 30 hours a week, I'm probably out of that deal because I just feel like that person, although maybe well qualified, well suited for this particular business, is not really in it for the future gains.
You focus a lot on fintech and it's a hot space right now. What do you see in that space at this point? Where is it going?
For me, I think that probably if you look at the broad base of fintech, I see a lot of it going into combining fintech and finding applications that might tie into some of the big buzzwords of today. So artificial intelligence, blockchain technology, and maybe even some sort of higher level of computing. But, at the end of the day, I still think that a lot of fintech and the way it interacts with individuals is very, very sort of one-to-one facing. And it may sound strange to people, but I actually gravitate a lot towards the type of fintech that is actually consumer facing. And it's just something I like. I feel like that there's still a personal human element to it, and you can't completely automate a bank transaction. But I do like the ones that are somewhat B2C lending, and they basically just make user onboarding or account opening or maybe access to money by an individual or a small business or medium-sized business easier. And I gravitate towards that type of fintech. And could just be that maybe I'm not well-versed enough to really evaluate properly a blockchain application related to fintech as well as it could be. And in those cases, I'd really have to rely on some of the groups that I'm involved with.
So you mentioned blockchain. That's an enabling technology. What do you see happening there that's interesting to look at?
It's funny. Blockchain to me inside of fintech is actually almost the same way that maybe 10 to 15 years ago, energy companies started talking about their investments into sustainable energy, alternative energy sources. And I kind of look at blockchain in the financial services or fintech space the same way, which is that are the big guys and the established players really going to keep trying to validate a technology, which ultimately, if successful, might eliminate some of their existing businesses, some of their existing modes, and probably a large way that they actually make revenue, money, and create customer stickiness today. So that's, even last week, I was at a conference, digital lending conference in San Francisco called Lend It. They had a whole different sub-conference that you could pay extra money to go to, and they called that BlockFin, that you could attend. And a lot of it was about just sort of decentralizing the way that financial services were offered, which I thought was interesting because if successful, that for the most part would render less of a need for some of the traditional financial services that we're all used to today.
Well, aside from blockchain, what are the other technologies you see out there that are really driving the changes out there? There's AI, there's data analytics, there's a lot of things, but what else do you see that's really moving the space in fintech? In
fintech specifically, I do think that artificial intelligence is very, very important. So some of the usage of artificial intelligence are actually not allowed just based on regulatory. You can't use it right now as the sole source of credit underwriting decisions because it likely might make decisions that would be deemed discriminatory. So there's protections from a regulatory standpoint. But aside from those, I think that artificial intelligence comes in and is more usable today because it might help both consumers consuming financial services and then also the enterprises offering those same financial services a quicker way to get and find the other side and meet in the middle to transact the deal. So I do see that happening a lot. by uses of artificial intelligence. Whereas blockchain, I think, will help make that transaction more safe, more secure, and maybe render some of the centralized escrow services in between irrelevant if successful long run. I think artificial intelligence today is speeding up getting to that transaction and closing today, which that's also very valuable in and of itself.
So when a startup comes to you and they say, hey, I want to go into the fintech space, what would you advise them to do in order to prepare before they go into the fintech space? What should they get ready for before they take the leap into that industry?
It's interesting. I just read an article this week. I can't remember the publication, but it was a national publication. And it talked about how 10 to 12 years ago, you would have just dove headfirst into trying to create some sort of company in the fintech space without regard to regulatory hurdles. And I think today, the article was actually arguing that it's almost the exact opposite, where you really need to start first by trying to determine if what you're going to do is something that's within the spirit of regulatory rules. So regulatory rules by nature are usually not very explicit of you can do this, you can't do that, you can transact business this way, you can't transact this business this way. It's not usually written out, but there is enough precedence and understanding of the spirit of these said rules. And the article said that people should look at that first. So when I talk to entrepreneurs getting into the space, there's two main things. One is that you don't need to be a regulatory expert. No one's going to expect that of you, but make sure that whatever you do is within the spirit of the law. And number two, which I think is even more important, is try to pick one little thing and be very, very good at it. I think a product and then validate that in the market and try to accomplish and solve 4 problems inside of one mobile app when they probably could become more valuable by just focusing and becoming very good on one. And if that one isn't the right solution that's getting enough traction, then switch to maybe problem number 2 that you would have otherwise done in your original platform idea. So focus and maybe a little bit of homage to regulatory concerns before you dive headfirst into the business.
And when you invest in these companies, how much time do you spend with them afterwards, and what do you do to help those get along? I think most angel investors are helping in different ways, but what do you find to be the most valuable way to help these startups?
In my particular position as someone who's worked in the industry, I've developed a pretty good Rolodex of folks in decision-making capacities at a lot of different financial services organizations and a lot of different siloed verticals within those organizations. So I think my best value in terms of return on time and money spent is probably making warm introductions for particular fintechs to some of the right channels within those organizations. So I think maybe I probably portray myself, I come in as an angel investor because I do want to prove that I have a little bit of skin in the game in the form of actual money. But my value probably comes across a little bit more as an advisor who's there kind of conscientiously making warm introductions. This week is a classic example at a payments conference right now. 2 of my portfolio companies are actually here in a pitch competition. One is directly related to the payment space, and my job is to kind of go help make some connections for them within large banking organizations for their payments and verification services. I think that's what I probably do better than anything else.
Well, that's great. In the last few minutes that we have, what have we not touched on that's important for what you're doing?
So for me, I think that some of the philosophies that I talked about just over the last few minutes, I'm eating a little bit of my own cooking. I have my own new fintech company out right now, and it is a consumer-facing play. And it really is a platform that's designed to make it easier for folks to access investment money in the form of IRA and 401ks, and then use those assets to invest in things outside of the traditional stocks, bonds, and mutual funds. So it's the type of investment that I would look for if I wasn't the person starting it. But that's what I'm working on right now. And I think that's a place to be. It's focusing on one particular, very, I guess you wouldn't say known problem, but known issue that's worth working on and solving. It's consumer facing. It's not relying on some sort of hard, unproven technology that I may or may not be able to build. And it's just simply easing the flow of capital from investment accounts that are characterized in retirement funds to potentially deals like you guys might talk about on this podcast.
Well, that's great. Well, how best can listeners get in touch with you? The website, LinkedIn, or what's best?
Yeah, so the website for the product itself, the company name is Rocket Dollar. Pretty simple. It's rocketdollar.com. So just rocketdollar.com. And then for me, I'm always open to networking and connections and answering any questions. And I'm pretty easy to find on LinkedIn. So my name is Henry, Henry, Yoshida, Yoshida. And you could just search for me on LinkedIn. I should pop up first.
Well, that's great. Well, thank you for sharing your experience with us today and what's going on in the fintech space. And we hope to have you back for a follow-up here very soon.
All right. Thank you very much, Hall. Appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.